This is the scariest words you can hear as an investor. Stock market crash is a sudden dramatic decline of stock prices across a major cross sections of a stock market, resulting in a significant loss of paper wealth, and most importantly, crashes are driven by panic selling and underlying economic factors. Crashes are generally unexpected. Famous stock market crashes include those during the 1929 Great Depression, Black Monday of 1987, the 2001 dot-com bubble burst, the 2008 financial crisis, and during the 2020 COVID-19 pandemic. Unfortunately, downturns happen more often than you might think. With that in mind, here are 3 steps that will help you to prepare for the next crash.
Hey guys, welcome to Financecator, the place where we spread financial yarn.
The first is adopt a long-term mindset. A long-term mindset is the single most valuable tool that an investor can possess. You might not understand the importance of it unless and until you apply that in real time. When you focus on the short periods of time, the market is very volatile. For instance, going back to 1928, the S&P 500, which is Standard & Poor. Standard & Poor is a company well known around the world as a creator of financial market indices, widely used as investment benchmarks. S&P 500 has generated positive returns in the month of August in 54 years, or 58% of the time. Now, if we zoom way out, the annualized return of S&P 500 is roughly 10% since 1928. Putting in another words, holding a stock for a month or even a year is little more than a coin flip. But if you hold a stock for decades, the odds of it being a profitable investment are much higher. That's why long-term investors have an advantage over their nearsighted peers. The second is invest regularly but build a cash position. No one knows the future. So instead of trying to time the market, you are better off investing on a regular basis. To help you with this, arrange to have funds automatically deposited into your broker's account every payday. Here is the trick. Don't invest every penny. That means do not invest all your money. You can keep 5% of your money in cash, but that number will vary depending upon on your personal comfort level. Some greater investors don't keep a cash position at all, and others prefer a cash position of at least 10%. The third is keep a watch list of high quality stocks. Some investors spend a lot of time looking for stocks that might fare well during market crashes. Unfortunately, a low tide typically sinks all boats, meaning that even the most resilient companies usually take a hit during a downturn. That's why I look for stock with strong perspective for future growth and solid competitive positions. These were the tips. On the other hand, gold, silver and bonds are the alternative investments which stay stable or rise when the markets crash. We will look at gold and silver first. This makes them attractive when the stock market is volatile.